The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
This is Don Creech.
And this is Perry Sykes. Welcome to the Investor Resources Podcast.
So we are going to talk about the economy, but there are some analogies we're going to make along the way, because the economy and inflation are pretty slippery things that the Fed has not been able to get its arms around.
Indeed.
Years ago, when we had campers and dirt bikes, motorcycles and stuff, we'd go camping with friends. And one of those families happened to own some property up near Forks, Washington. And that property was ideal for camping and motorcycling. It was called the Boogie Bottom Slug Farm.
There you go.
So it was a little sloppy. But we were there for the celebration. And this last week of September, I think we could pretty well say most of the county fairs are pretty well wrapped up at this point in time.
True enough.
One of the things that was fun and exciting that we really hadn't expected was Forks had a greased flagpole competition. And it's funny to watch guys, generally guys who are macho enough to wrap their arms around that slimy thing and attempt to crawl up to the top. And I believe there was a bell up there that had to be rung. That was it. And if you did that, there was a big prize of some sort. And it turned out that one of the young boys in our group, young teenagers, he was kind of smart. He waited until everybody else had wiped as much grease as off the pole as was going to happen. But he actually made it to the top.
Little strategy there. There you go.
And I don't remember clearly, because it's a couple of decades back that we did that. But it seems to me that right along with a greased pole, you get greased pigs.
Oh, sure. All the time at fairs. Absolutely. Absolutely.
And so that's kind of like a staple of a county fair, is it not?
Always there. Always there.
And I see this on movies. I like to watch Westerns, old Westerns and stuff. And you see this kind of activity. Humans aren't really very quick when it comes to chasing down a pig. And if you get your arms around it and it's been greased, it's really hard to get one under control. So it's kind of,
and the pig rarely cooperates. So yeah,
right.
Pig's not going to help you. So yeah.
But we think of this activity as basically the same kind of problem that the Fed is having with regard to trying to tame inflation. It's how do you get your hands around something when they're trying to control something that they basically contributed to? I'm not going to give the Fed blame for inflation, but clearly they get blamed for contribution. Because the biggest issue, and I think the biggest responsibility, comes with Congress. Or maybe let's say it's the FDA and the EPA, government agencies that said, we have to shut this world down because of COVID, the pandemic, and not understanding what was going on. Or we now think they understood a lot more than they let on at the time. But be that as it may, when they created a huge disruption between supply and demand. And then they said, well, nobody's working. They need money. So let's just give them a bunch of money, which what are we going to do with all this pile of money? We didn't know we had these kind of reserves. Let's start buying stuff. And they're buying things that are in short supply. What happens when in that situation? Prices rise. I want that.
Ton of money. Yeah, ton of money chasing too few goods and products. And the government, of course, when they decide to help everyone, the opposite came true. They didn't really think it through. And all of a sudden there was a huge surplus of cash sloshing around in an economy with not enough goods and services to pass around, and almost no way to get to them if you could find them. And inflation, of course, naturally followed, as really anyone who was thinking about it even a little bit would know was going to happen.
So since the pandemic, we've basically been living in an economic version of the greased pig game
Right.
because stuff keeps slipping out of our hands. Inflation has been running free. The we're nowhere near the 2% target that the Fed wants.
Right.
But then that raises another question. Why is 2% the right rate?
It's a pretty random number. You're right, Don. It's a random number they picked, and they're not coming off it. They're saying 2% is what we need, and we're gonna keep our interest rates in place until we get to our 2% target, regardless of why we have a 2% target.
Well, the 2% is still bad news over time. It's just it's a slower number. It's an
Sure.
easy it's an easier number for businesses to adjust to, for wages to adjust. This rapid rise we had in the last couple of years is just uh, very, very disruptive. But even at 2%, the cost of financing government continues to rise.
Right.
And if you don't have an economy that's growing at a faster pace, you are going to run out of money at the government level,
There you
or
go.
you print more and you create more inflation. I mean, this is a vicious circle, if you will. We have August CPI numbers show that inflation actually increased from the same time last year. The Fed likes to look at core, which means you don't need food or gasoline.
Correct.
Therefore, we can control stuff. But reality is,
Mm.
you probably still go to work, you go to the grocery store, go to your physician's office, take the kids to school or get them there some way. I mean, maybe on a school bus instead of you driving them. But the fuel issue doesn't go away. And government, in its righteous knowledge, has determined that we don't need fossil fuel anymore because they're focused on electric vehicles, EVs. However, we can't produce enough EVs, and if we did, we can't produce enough electricity to support them. We don't have the infrastructure on the electric grid to take care of it. So
You
we
know, when you
still
say
have
it
to,
like that, Don, that sounds like a serious issue. You know, you make it sound like that could be a big problem. Yeah, I think it's a huge problem, and there's just being ignored right now. Ugh.
well, we do have resources as far as the precious metals are concerned, but the administration, in its righteous knowledge, has increased regulations, making it more and more difficult to do the mining. And a topic for another one of these sessions is something I just learned this week, and that is the mining we are doing of lithium, cobalt, copper. We don't do that much copper here in the country, but around the world, they're very water intensive, and these activities are actually dropping the groundwater level of communities, which are not going to be able to survive due to lack of water, due to the demand for rare minerals to create a
Yep.
demand for EVs. Another vicious circle that hasn't been well thought out or planned. There is no provision for dealing with the damage to the water table in so many areas around
Unintended
the world.
consequences. We always get them, and here's another one. It's
But that's a
endless
little bit
stream.
of a rabbit hole as far as inflation is concerned. So basically, most of this inflation that we've had is really tied to fossil fuels. If we don't have fossil fuels, or
Yep.
it's not available, we can't transport product. You've got to get stuff to the stores. I mean, from the manufacturing or from the farm to the warehouses, the processing plant to the distributors back into the retail store. It doesn't matter whether it's food, clothing, pharmaceuticals, automotive parts. They're all affected by that. And we had a little bit of a release or relief in the last couple of months as oil prices dropped globally. but recently they are ticking back up, and that seemed to have had a catalyst of the president going to Alaska and saying we are going to shut down ANWR, and then going to New Mexico and saying we are going to shut down production here. We aren't going to allow any oil drilling or exploration. So
Hmm.
it uh, kind of looks like he's in partnership with the Saudis to raise the price of energy on the global market by restricting production of a product that is absolutely essential to keep the economy moving. And if that price goes up, which it has recently, in fact, the West
Right.
Texas oil recently traded above $95. Now it's backed off a little bit. It's down around 91 as of today's market. But that's headed in the wrong direction. So we still
And
have
energy,
this.
like you said, energy is one of those things that affects all other prices in the economy. If there's an inflation on the energy side, that seeps into everything. Everything becomes more expensive. It's more expensive to make. It's more expensive to deliver. It's more expensive to go purchase it. It raises costs across the board. So it's very inflationary. It's very sticky. It's slower to move, and we really need to get the grip on that. We really have to get that under control.
So part of this is more than just simply investor or consumer perception, because
Correct.
when you go to the gas pump, it's not, well, I thought I saw gasoline at $5 a gallon. No, that didn't happen. No, that was in my imagination. And we know it's not our imagination because it affects our pocketbook directly. But
Correct.
the question is, how on earth is the Fed actually going to be able to do something that doesn't create the recession that they don't want?
Right.
But the closer we get to this issue, the more it looks like a recession has just simply been pushed off into next year. Yeah. It's not, we don't know when, but all the signs that typically lead to a recession are pretty well in the cycle right now.
It looks like we're heading that way. And now that the Fed has come out and said for sure, we're probably about done raising rates. We're not going to go much higher than we are right now, but we're going to keep them high for a longer period of time. And that's really got recession written all over it. That really makes it tough for a soft landing scenario to actually happen, because those increased rates, those make everything more expensive, especially businesses who need to borrow to run their business. All their input costs are going up. That's inflationary by itself. So it makes it harder and harder to get the inflation out of the way and let the economy work, if those rates stay higher longer. And now the Fed has stated, in public, we think that's where we are, and we think that's what's going to happen.
And that's why the bond market is where it is today.
Yeah.
The end of the FOMC meeting last week, and Chairman Powell's comments that higher for longer seems to be the story, changed the perception of bond investors. Bond investors as a whole were anticipating that in 2024 we would see 4 rate cuts, and we might even have seen one this year. And he dashed that to pieces. It was like taking a hammer to a china bowl and just shattered it. And now we're looking at, are we going to have another rate hike even before the end of the year, and another one in the
Right.
next year, before we start seeing another pause? So instead of getting a pause, we got to skip. We're going to skip this time, but expect us to do something in the next 2 meetings. That really upset the bond market and the stock market last week. That's the perception problem. Now we still deal with what you referred to a moment ago. The reality of inflation is affecting us in our pocketbooks. And the Fed's done everything it can to try and get the inflation pig back in the pen,
Right.
but it's a slippery issue. They made the mess, or at least they contributed to the mess. And it's when you make your own mess, it's always difficult to clean it up yourself. It's a whole lot easier to
Correct.
point to somebody else and see what we can do to do that. inflation in and of itself is a pretty slippery issue. I mean, you just simply don't know exactly how the economy is going to adjust to the various inputs. It's extremely volatile, and it's not either this or that. There are
Right.
too many thises and that's to get an integrated part and say, well, this is the way it's going to turn out. That may happen in a communist country where they say it's not happening our way and you either do it this way or you're dead, which, we see some of that over in China. You
We've
don't
seen
like
it.
that? Maybe they won't kill you, but they're going to lock you up and keep you from doing what you want to do. In a free society, we still are mostly free. The the variables are just too many.
There are. I think that's why the Fed is saying, we're data dependent now. We are data dependent because clearly they don't know exactly how this is going to play out. They don't know exactly where it's going. And when they change things, they have no idea exactly how it's going to work. So they're going to have to wait and see with the rest of us. And that's always been the way it is. But right now, everybody's focused on the Fed because everybody's tired of the rate increases. They want them to start. There was already a lot of rates coming down next year. That was baked in already. And now they're saying, wait a minute, maybe we're not going to get any decreases next year. And if not, certainly not in the first half of the year. So like you said, Don, it's kind of changing the outlook, changing the perspective in the investment markets of what the Fed's trying to do and what they may be forced to do, whether they want to or not.
So the big variable actually is the U.S. consumer. How
Yeah.
many consumers do we have in the country, and they don't all think the same? They don't all have the same needs. They don't all have the same money to spend, but they are going to do what they can with what they have that satisfies their needs. And you can't predict
Yep.
that. And unlike in China, when they just lock people into their condos for extended periods of time, we, well, we did come close to that.
We were in the ballpark. Yeah.
Yeah, but we probably aren't going to get away with that again. And you have the transportation issue. I mean, cabs, Ubers, trucks, your Amazon delivery, all these things are variables. The consumer changes what it wants and how it's going to get it, and services, business adapt. If they don't adapt, they go out of business. I mean, that's a capitalist system. And I think as the economy slows down into next year, we're going to see more sad stories about businesses that had,
Sure.
at least initially, looked like they had great futures unwind. We've had a
Yep.
couple of initial public offerings, IPOs, here this last few weeks, and the excitement about bringing a company into market and let it trade has quickly faded because those stocks haven't continued to go up. They've quickly reversed after the initial trading date. And that's a sign of the times. Unpredictable future for these businesses, and the ability to raise more money to stay operationally is becoming more difficult, particularly when investors are looking at the high interest rate of federal treasuries. My goodness, you get the 2 year, when I looked at that, was almost 5.5% 2 year treasury. It's ironic that the, the most secure credit-worthy government bond is issued by one of the most bankrupt entities in the world. But
Yeah.
that's
Pay
perception.
no attention to the man behind the curtain. Yeah, it's fine. We're fine here. Don't worry about that. Yeah.
It's just the perception. But the bottom line is this comes down to our pocketbooks. How do people handle this stuff? And if this continues on the current track, by the time we get to the next election, we're already in the election cycle, the early stages of it. I think we're going to see some very big shifts that right now are not fully embraced by the media or by a lot of politicians. But
Correct.
I think politicians are going to be held accountable for this. The this basically, we're talking about pig wrestling. This isn't something like horseshoes. Horseshoes, you can be close and still win. If you're wrestling a pig, I mean, you got to take it down, and
Either you
that's a
have it
more
or you don't. And the Fed knows we don't have it yet. The Fed knows we don't have inflation under control, and the Fed is way less concerned with the way the economy looks than politicians. Politicians are worried about that because that affects votes. The Fed's focused on inflation, and they know if that number doesn't come down, they're the ones that are going to get hung out to dry for it. So they want that number to come down, and if it takes a recession, I think they're fine with that. If the U.S. consumer will not stop spending and we just keep spending like it, we're complaining that things are more expensive, but we're still paying for it all. We're going to have to wait for the business side to slow down, and that's going to take a little longer. And the Fed says we don't care. We're going to leave rates as high as we need to for as long as we need to. So that's kind of where we are, and we're going to have to wait and see how that plays out.
So what you're referring to in economic terms is called demand destruction.
Correct.
We have to convince the consumer that they aren't in a good position, so they quit spending money. They get scared. That's not what the politicians want, but that may be the only way that the Fed actually manages to unwind this. Now,
Correct. Yeah.
the Fed is actually trying to figure out what's going on. And the first real current effort, current economic modeling effort, came out of the Atlanta Fed. And they created GDPNow model. And it was a real innovation in the way economists take a look at the economy. Instead of relying solely on trailing data, they were doing much more current data gathering and built this particular model called GDPNow. You can go online with do a search for GDPNow. You'll end up on their website. Once they did that, well, the New York Fed said, we can do it better.
If you've
And
got a
then
new toy, we need a new toy. Yeah. So
And then San Francisco said, we can do it even better than that. And now Chicago's done that. And what's interesting with all these presumably smart, at least they're educated,
sure.
economists at the Fed and these various branches, you would think they could come to some sort of an agreement, but they don't. They haven't. It is a good effort, but it's still just a best effort to try to figure out where are we and where are we headed. But there's a big spread between the pessimist and the optimist, even though they all
Right.
have slightly rising numbers for next year. Some of them are saying it's 1%. I think Atlanta Fed says it's going to be 2.5% GDP. Well, 1% GDP is very slow growth. That doesn't support an expanding economy. The demands are too great. Uh, and the others are more sanguine, I think, about our
Bottom
near-term
line
future.
is these are the guys that are going to actually determine what's going to happen with the federal funds rate, and they've got no consensus on what's going on with the economy. So that's in their real-time estimates anyway, in the GDP now numbers. They're all over the board, and that doesn't make it any easier for the rest of us to sit around and watch and try to figure out what they're going to do because the Fed is not even in agreement on what the baseline numbers are.
So if those smart guys can't figure out what's going to happen, perhaps
Right.
we should look at the smart guys on Wall Street. They have smart money there. They get paid a lot more than the guys at the Fed. At
They
least
do.
that's my impression and
They
understanding.
do. Yep.
But in my morning email, I noticed a discrepancy between the opinions of where the market should be. I mean, last week was the worst week we had for the S&P since March, but we're still inside a normal market fluctuation range. This isn't a bear market sell-off. This
Correct.
is investors trying to figure out, well, if interest rates are here and growth is there, then my particular stock should be worth X more or less than I thought it was before. This
Correct.
is normal market readjustment based on new new data, new facts. And that's what the market does all the time. But you should ignore strategists. Our view is look at the chart. What's the chart tell you? If it's going up, that's the direction you want it to go. If it's going down, that's not normally the direction that people are investing in.
Not what we're here for, right?
And then it's your time frame. But when we take a look at where the strategists are after the recent Fed meeting, the Bank of America chief of strategists raised her year-end target. So did Oppenheimer, so did Fundstrat, Piper Sandler, Credit Suisse, Societe Generale. Some of them were as high as 4,900. And we're pretty close to 42 right now. We didn't make it today because we got a little bit of a relief rally off of last week's selling. However, at Morgan Stanley, Michael Wilson still expects it to go lower to 3,900. So
There you go.
if they're all so smart, why isn't there more agreement here that would give us a greater degree of confidence about the direction that we're headed in this last quarter that's just ahead?
Right. And it just goes back to this being a grease pig economy. There's no way to figure out which direction it's taking next. And that really is true always. No one ever really knows where the economy is headed, and everybody's willing to make a guess and make a big prediction about the target for an index for the end of the year. What the heck? Put it out there. If you're right, you're famous. If you're wrong, nobody remembers. So there's no downside to all the prognosticators, but it is important to not get wrapped up in those. Take them with a grain of salt. That's nothing that you should ever base a portfolio move on, because they're just taking a guess. And the number of things that need to happen for their guess to come true is just as long as for the next person. And they're all just throwing a number out there saying, well, this could happen. And yep, it could, but will it? Probably not. It'll probably be something that no one even sees coming.
Well, what no one sees coming would probably fall into the black swan category.
Sure.
A major negative event would be disruptive for the market. At this point, it's just basically grinding our way onward and upward. It's just that the grind is not very comfortable at times. So part of this, when we say let's look at the charts, is your time frame. Are you a day trader? It's probably not you listening to this, but if
Hopefully.
you are, you have to look at your weekly, monthly, quarterly data to figure out which trend you're following and allow for the give and take of Mr. Market changing his mind and being pushed around by headlines. The headlines are not an investment policy. Process is what works over time. Trends develop, trends work, even though they can't be mathematically reconstructed on the fly. It depresses academics because they can't build a theory around trend. But that is the way we approach the markets. The charts don't lie. The charts tell us exactly what both buyers and sellers have agreed to. Now, some days, like we saw last week, is not a lot of buyers show up. And if buyers don't show up, that means sellers are the most dominant party. And somebody will come in and buy on the cheap, at least what they believe to be on the cheap. But it creates a certain level of short-term uncertainty. Do not be discouraged by that. Stay with the process. Follow the charts. There will be a determination that resolves the uncertainty one way or the other. And if it's to the downside, you protect your capital. If it's to the upside, you add capital to it. That's a simplified investment process right there. Protect your capital, add to the things that are winning, get rid of the things that are not. I think that's a wrap for today, Perry.
There you go. We covered it.
Okay, subscribe to our website, share it with your friends and family.